When a crisis hits, we expect our leaders to step in, to do something. But what if the fix itself, the very thing designed to save the day, actually plants the seeds for an even bigger disaster down the road? It's a real tightrope walk for policymakers, and that's what we're digging into today. So this is really the core question, right? How can doing the right thing now end up being the wrong thing for the future? We're going to look at how a really powerful emergency tool, one used to stop a banking panic back in 2023, might have accidentally made the whole financial system just a little bit riskier, and what that tells us about a much, much bigger threat that's hanging over the entire U.S. economy. All right, so to really get this, we've got to rewind the clock a bit to the banking turmoil of early 2023. It is a perfect case study. You've got the crisis, the dramatic response, and then all the unintended consequences that followed. It all kicked off with something that sounds pretty simple: rising interest rates. The Federal Reserve was trying to get soaring inflation under control. So back in March 2022, they started hiking rates. But that move had a predictable and pretty dangerous side effect for the banking world. And you can see the impact right here. It's pretty stark. As those rates climbed, regular people and businesses suddenly realized, hey, I can get a much better return on my cash somewhere else, like in money market funds. So what happened? They started pulling money out of their bank accounts, and you can see that clear drop in deposits. For some banks, this cash exodus became a very, very serious problem. And that pressure cooker just exploded in March 2023. It all centered on Silicon Valley Bank. They announced they had to sell a bunch of their bonds at a huge loss just to get cash to pay back depositors. Well, that news sparked an absolute panic. The next day, you had a full-on 21st century bank run on your hands. And by March 10th, it was done. Regulators stepped in and seized the bank. The big fear was that the panic was about to spread. Okay, so with the whole financial system kind of teetering, the government knew it had to act, and act fast, to stop the dominoes from falling. Their answer was a brand new, break glass in case of emergency kind of program. They called it the Bank Term Funding Program, or BTFP for short. And the way it worked was actually pretty brilliant. The main problem was that banks owned all these bonds that were now worth way less on the open market. The BTFP let banks borrow cash from the Fed using those bonds as collateral, but, and this is the absolute key part, the Fed valued the bonds at their original price, what they called par value. This was a game changer. It meant banks could get all the cash they needed without having to actually sell their investments at a massive loss. And boy, did it work. I mean, it worked like a charm. You can see here, banks rushed to use this thing, pledging nearly $500 billion in collateral in just a few months. The panic? It just stopped. The immediate crisis was over. A win for the good guys, right? Well, this is where the story takes a fascinating turn. See, every powerful safety net comes with a hidden danger. By removing the fear of falling, you can actually change how people behave. In the world of finance, that danger has a specific name: moral hazard. Just think about it this way. If you have the world's best car insurance, full coverage, zero deductible, you might just be a little less careful about where you park, right? You know that if something goes wrong, someone else is picking up the tab. Well, in finance, it's the idea that if banks believe they'll always be bailed out, they have way less reason to protect themselves from risk in the first place. And the policymakers, they knew this was a risk. It's not like this was a surprise. Just a few months after launching the BTFP, they were already out there in public warning banks, hey, don't get too comfortable. Don't assume we can pull a rabbit out of a hat every single time. So the message from the regulators was loud and clear. Fix your problems. Get your house in order. Prepare for the next storm. But a really fascinating study, one that came from researchers at the Fed itself, found that the reality was pretty much the exact opposite. The banks that had the easiest access to this new safety net, they did the opposite of what they were being told. And the evidence is pretty stark. The study found that the banks with easy BTFP access were less likely to go out and raise cash from private investors. They were less likely to set up backup funding plans with other banks. They didn't even bother to test their ability to borrow from the Fed's permanent non-emergency loan program. And get this, they were actually more likely to sell off those risky bonds, the very thing the BTFP was trying to prevent in the first place. They basically used the safety net as cover to take even more risks. So here's the bottom line. The very tool that solved one crisis made banks complacent and less prepared for the next one. But this isn't just a story about banks. This is a pattern. And what we just saw is actually a miniature version of a much, much bigger dilemma, one that's been playing out with America's national finances for decades. 100%. That's the U.S. national debt as a share of the entire American economy. Let that number sink in. It is absolutely staggering, and it's getting very close to all-time record levels. And just like that bank rescue program, every single emergency fix, whether it's for a pandemic, a recession, a banking panic, you name it, it all adds to this enormous mountain of debt. And it creates this expectation that the government will always be there to step in, which in turn increases the risk of something far more dangerous, a national fiscal crisis. So, what does a fiscal crisis even mean? Well, it's not just one thing. It can actually take a lot of different and equally damaging forms. A report from the Committee for a Responsible Federal Budget lays out a few pretty chilling scenarios. First, you could have a sudden financial crisis where global investors just lose faith in U.S. debt, causing interest rates to skyrocket. Or you could have an inflation crisis where the government is pretty much forced to print money to pay its bills, which would crush the value of the dollar. And then there's maybe the scariest one, a gradual crisis. Not a big bang, but a slow burn, where this high debt just quietly strangles economic growth and chips away at our standard of living, year after year after year. And you gotta understand, this is not just a US problem. I mean, look at who holds all of this debt. Yeah, more than half is held by Americans, but a full third of it is held by foreign investors and other governments. A US fiscal crisis would become a global crisis almost overnight, sending financial shockwaves to every corner of the planet. Which brings us right back to where we started. That banking program showed us on a small scale how a great safety net can make us reckless. Well, on a national scale, this unspoken promise that the government will always be there to fix any problem has allowed our national debt to explode. The safety net has just gotten bigger and bigger and bigger, and that leaves us with one final and pretty urgent question. What happens if one day it